In 1923, in Berlin, a postman named Friedrich Keller woke up to find his salary barely enough for 2 loaves of bread. 3 months earlier, that same amount could feed his family for a week. By the end of the year, a wheelbarrow full of banknotes was needed to buy a single dinner. The German mark had lost almost all its value. The savings of the middle class had evaporated in just a few months. But amidst this chaos, some assets increased exponentially in value. Those who held land, gold, industrial shares, or tangible assets that could be revalued by inflation not only survived, they expanded their power. A century later, that story is no longer in history books. In the last 5 years, the balance sheets of the world's largest central banks have ballooned by trillions of dollars. The amount of money in circulation has outpaced the real growth of the economy. Real estate prices in many major cities have doubled in less than a decade. Gold prices have set new highs. Scarce assets are surging while cash is losing its purchasing power. This brings to a chilling reality: when currency weakens, not everything collapses. Some assets not only withstand the pressure, they outperform. And in the process, wealth is quietly redistributed. This isn't a story about investing. This is a story about structure. When the monetary system enters a period of stress, which assets are revalued? Where does the money flow? And why has every major monetary cycle in history produced a clear winner group? What's happening today may not be an immediate collapse, but the signs indicate a period of quiet revaluation is forming. And to understand that, one needs to look beyond the surface layer that the public is often told. In every period of monetary stress, the public's initial reaction is often very similar. It's argued that asset prices rise because of economic growth, because of technological advancements, because of urbanization, because of limited supply. These arguments aren't wrong. They're partly true. But they don't explain why the biggest asset price surges often coincide with periods of extreme monetary easing or crises of confidence in the currency. After the 2008 financial crisis, when the Federal Reserve began expanding its balance sheet through large-scale asset purchase programs, many believed this was merely a temporary measure to rescue the banking system. But in the following decade, the prices of financial assets, particularly stocks and real estate, rose significantly faster than workers' incomes. It's explained that the stock market surges are due to improved corporate profits. That's true to a certain extent. But as the cost of capital falls to near zero, asset valuations no longer reflect only current returns. They reflect expectations of abundant future liquidity. Cheap money drives investors to seek yields everywhere. In Europe, when the European Central Bank implemented large-scale bond buying programs, government bond yields even fell into negative territory. In that environment, holding cash meant losing purchasing power over time. Holding bonds meant accepting negative real yields. Money began to flow into scarcer assets: land, corporate stocks, gold. But the common narrative the public hears remains: prices are rising because the economy is recovering. The problem is that asset prices are rising much faster than real growth. When GDP is growing 2 to 3% annually but house prices are rising 10 to 15%, that disparity cannot be explained solely by productivity growth. In many countries, the home price-to-income ratio has reached its highest level in decades. Stock prices, measured by their P/E ratios, have far exceeded historical averages. Gold prices are constantly challenging new highs amid record-breaking global debt. If this were just a normal economic cycle, the global synchronization of these trends would be difficult to explain. History shows a recurring pattern. When the money supply expands faster than real growth, tangible assets and assets capable of preserving purchasing power are often revalued before the official currency collapses. This doesn't happen overnight. It unfolds subtly, through a mechanism of continuous revaluation. Surface observers see prosperity. Market indices peak. Real estate prices rise. Household net worth reaches record highs. But behind it all is a shift in financial power, from holders of cash to holders of scarce assets. When a currency weakens, the story isn't everything goes down. The story is that some things rise faster than the rest. And it is that disparity that creates the largest wealth transfer in each monetary cycle. What we are witnessing now may not be a complete collapse. But the dynamic structure is shifting in a direction familiar in history. To understand why some assets appreciate when the currency is unstable, we need to dissect the inner workings of the system, how money is created, allocated, and revalued. When a currency begins to weaken, the first thing that changes is not prices, but the dynamic structure within the system. The modern monetary system operates on credit. The central bank creates liquidity, the commercial banking system multiplies that liquidity through lending, and credit flows into areas with the greatest capacity to absorb capital. In a stable environment, this flow of money supports production, investment, and consumption. But when interest rates are kept persistently low, the incentive structure begins to distort. Low capital costs make borrowing to buy assets more attractive than saving. If bank deposits yield negative real returns, while house prices rise 8 to 12% annually, the economic incentive becomes clear: borrowing to own scarce assets. This mechanism creates a feedback loop. Asset prices rise, mortgage values rise, banks are willing to lend more, liquidity continues to flow into assets, and prices continue to rise. This is not natural growth. This is a feedback loop fueled by the monetary structure. During periods of monetary stress or distrust, this loop accelerates even further. When investors doubt the purchasing power of the currency, they turn to tangible assets or assets with limited supply. This explains why, during periods of high inflation or currency crises, gold, land, and shares of businesses owning real assets often appreciate sharply. The transfer of wealth occurs silently. Holders of cash experience a weakening of their purchasing power. Holders of assets that can be revalued by inflation preserve, or even increase, their net worth. The difference lies not in the absolute increase, but in the speed of adjustment relative to the currency. Historically, there are 8 asset classes that are often strongly revalued when the currency weakens. First is gold. When fiat currency loses confidence, this precious metal becomes a psychological anchor. Not because it generates money, but because it cannot be printed further. During periods of extreme inflation, the price of gold in local currency often increases exponentially. Second is real estate in scarce areas. Land cannot be replicated. When money depreciates, the nominal price of land increases, especially in large cities where supply is limited by planning and geography. Thirdly, there are corporate shares that own real assets, such as energy, mining, and agriculture. These businesses are able to pass the cost of inflation on to consumers and maintain profit margins. Fourthly, there are basic commodities. When a currency loses purchasing power, the prices of oil, industrial metals, and food often reflect this before official economic indicators have a chance to update. Fifthly, there are assets in economies with better fiscal discipline. International capital tends to move away from weak currencies to find relatively safer havens. Sixth are assets with algorithmic scarcity structures, such as Bitcoin. Over the past decade, this asset class has been seen as a digital response to concerns about monetary expansion. High volatility, but a fixed supply mechanism, makes it a tool for speculation on the weakening of fiat currency. Seventh are businesses with strong pricing power. When input costs rise, they can raise selling prices without significantly losing customers, protecting real cash flow. Eighth are fixed interest debt assets in an environment of rising inflation. Borrowers repay in a currency that will depreciate in value in the future, while lenders suffer losses. The commonality among these assets is not that they are good or safe. The commonality is their ability to adjust to inflation faster than cash. When the monetary system is under pressure, scarce assets, or pricing power often become a place for reallocating liquidity. But this mechanism also creates increasing inequality. Asset owners benefit from the revaluation process. Those with only labor income and cash savings are left behind. The wealth gap widens not because they work less efficiently, but because the monetary structure favors assets over labor. This sets the stage for the next phase of the cycle, when data begins to reflect the accumulated stresses in the system. Looking at modern indicators, the picture begins to become more strained. Over the past decade, the Federal Reserve's balance sheet has repeatedly exceeded $8 trillion after periods of extreme easing. At the same time, the total U.S. public debt climbed above $34 trillion, driving up annual interest costs as interest rates turned upward. The massive liquidity injected into the system during the crisis didn't disappear, it was reallocated. The ratio of home prices to household income in many major U.S. cities is at its highest level since before the 2008 crisis. Meanwhile, the real income of the middle class is growing at a slower pace than the increase in property prices. This disparity creates a double effect: the assets of homeowners are increasing on paper, while those who haven't yet entered the market are increasingly pushed further away. The S&P 500 index has set new highs for several consecutive years, despite the fastest interest rate hike cycle in 4 decades. Stock valuations are high compared to historical averages, even as corporate earnings growth begins to slow. Liquidity accumulated from the period of cheap money continues to find its way into financial markets. Gold prices are also reaching new highs amid record global debt and increasing geopolitical instability. This is reminiscent of periods when the precious metal was revalued when confidence in fiat currency wavered. If we put these figures side by side and compare them to pre-crisis periods in history, from the 1970s with double-digit inflation in the US to the debt crises in Latin America, a striking pattern emerges: nominal assets are rising sharply while fiscal and monetary foundations are becoming more fragile. The debt-to-GDP ratio in many developed economies is now higher than at any point in peacetime. Interest expenses are accounting for an increasingly large proportion of government budgets. When budgets have to dedicate a large portion of resources to interest payments instead of investment, the ability to sustain long-term growth is called into question. At the same time, real interest rates, after adjusting for inflation, often remain low or negative. This erodes the traditional incentive to save. When holding money means losing purchasing power, money tends to flow away from cash in search of refuge in tangible assets. A formal declaration of a monetary crisis isn't needed to initiate the revaluation process. A persistent imbalance between real growth and credit expansion, between labor income and asset prices, between debt and repayment capacity. These indicators don't inherently cause collapse, but they create a simmering sense of unease. And it is within this context that a quiet redistribution of wealth takes place. Asset owners continue to benefit from asset inflation. Non-asset owners face a cost of living that outpaces wages. Looking at the data, what's noteworthy isn't a single number, but the synchronization of multiple indicators moving toward strain. High liquidity, high debt, high asset valuations, slowing real income, fluctuating consumer confidence. These pieces of the puzzle don't produce an immediate conclusion, but they create a sense of familiarity for anyone who has studied long-term monetary cycles. And as the numbers begin to reflect the pressure, the impact doesn't stop at the balance sheet. It spills over into the social structure. When assets appreciate faster than income, the consequences aren't just numerical discrepancies. It begins to reshape the social structure. The middle class, once considered the stable foundation of developed economies, relies on a simple assumption: hard work, consistent saving, buying a home, and accumulating wealth over time. But as house prices rise at a rate many times faster than wages, entry into the market becomes increasingly out of reach for the younger generation. A young family in many major cities today must dedicate a significantly higher percentage of their income to rent or mortgage payments than 2 decades ago. The initial down payment is higher. The accumulation period is longer. Meanwhile, those who already own homes see their property values increase dramatically, even if they don't generate any additional real output. This polarization doesn't happen dramatically. It occurs through asset revaluation. Those with assets benefit from asset inflation. Those without assets are trapped in a spiral of rising living costs. This pressure spills over into deeper personal decisions. The age of marriage rises. Birth rates fall. Young people delay starting families due to financial instability. Internal migration increases as workers leave expensive cities for lower living costs, leading to labor market and infrastructure instability. On a psychological level, when workers feel that their efforts are not keeping pace with asset prices, confidence in the system erodes. This doesn't necessarily lead to an immediate crisis, but it creates simmering discontent. History shows that periods of monetary instability often coincide with increased political polarization and social unrest. As inflation erodes real wages while assets continue to rise, the gap between rich and poor widens. Those who own corporate shares, real estate, or scarce assets see their balance sheets swell. Those who depend entirely on wages are unprotected against the revaluation process. In many developed economies, the share of financial and real estate assets in total household assets has risen to record highs. This means that asset market volatility directly impacts societal perceptions of wealth and poverty. When the market rises, a feeling of prosperity spreads even if real incomes don't change proportionally. When the market reverses, the opposite effect can occur rapidly. The deeper impact lies in the fact that the modern monetary structure prioritizes those who have access to credit and assets first. Those who enter the system later must acquire assets at prices that have been repeatedly revalued. They bear higher risks while having relatively less room for asset growth. This vicious cycle creates a prolonged state of tension. Not enough to cause an immediate collapse, but enough to alter the expectations of an entire generation. And when expectations change, pressure mounts on policy. But policy doesn't operate in a vacuum. It's constrained by the interests of groups that have benefited from the asset revaluation process. A bottleneck begins to form here. When assets have been repeatedly revalued in a cheap money environment, the system falls into a peculiar state. It cannot easily reverse course. If interest rates rise sharply and remain high for an extended period, asset prices are under pressure to adjust. Credit-dependent real estate will decline as borrowing costs increase. The stock market is heavily discounted as bond yields become attractive. The massive debt accumulated during the period of cheap money begins to become expensive. But asset price declines are not a politically neutral option. Millions of households have tied their net worth to home prices. Pension funds depend on market yields. Banks hold collateral on their balance sheets. Governments rely on taxes from capital gains and economic activity related to assets. If assets fall sharply, the wealth effect can reverse, leading to a recession. As people feel poorer on paper, they cut spending. Businesses scale back investment. Growth slows. Government revenues decline. In a system with high debt, slow growth causes the debt-to-GDP ratio to deteriorate rapidly. Conversely, if policy reverts to easing to protect asset prices, pressure on the currency increases. The influx of new liquidity could continue to push asset prices higher, deepening the wealth gap and increasing the risk of a bubble. The system is therefore caught between two unpleasant choices: accepting a painful adjustment or prolonging the imbalance. With record-high public debt and ever-increasing interest costs, the ability to maintain high interest rates for an extended period is limited. The government must refinance trillions of dollars in debt each year. High interest rates lead to a heavier budgetary burden. Pressure to maintain sufficiently breathable financial conditions prevents a systemic collapse. This is a structural trap. Once the system relies on high asset prices for stability, normalization becomes difficult. Each time the market experiences a sharp correction, expectations of policy support emerge. And that expectation itself influences investment behavior, reinforcing the belief that large assets will be protected. This state could last for years. It's not an instantaneous explosion, but a continuous tension. Asset prices fluctuate more wildly. Policy shifts more rapidly. Confidence becomes more fragile. In that environment, scarce assets, or those whose value is likely to be determined by inflation, continue to serve as relative safe havens. Not because they are immune to volatility, but because they are seen as a hedge against currency risk. History shows that when a system is stuck in this state for too long, major adjustments often don't come from proactive decisions, but from an external shock, a banking crisis, geopolitical conflict, or a sudden loss of confidence in the ability to control debt. It's noteworthy that before each such period, these patterns have appeared many times in the past. Looking back over the centuries, this pattern is not new. In the 1970s, when the United States abandoned the gold standard under Richard Nixon, inflation soared. The price of gold rose from a fixed $35 an ounce to over $800 by the early 1980s. Real estate and basic commodities also underwent a period of sharp revaluation. Holders of tangible assets preserved their purchasing power far better than those holding cash. In Latin America during the 1980s and 1990s, currency crises repeated themselves many times. The local currency depreciated rapidly, but land, dollar-denominated assets, and exported goods rose sharply in nominal value. Those able to convert assets to more stable currencies or tangible assets avoided the greatest erosion. During the hyperinflation in Germany in the early 1920s, real estate and industrial share prices rose exponentially by Mark, while middle-class savings were almost wiped out. That process was not just inflation, it was a large-scale redistribution of wealth. Even during the 2008 financial crisis, though different in nature from hyperinflation, the pattern of wealth transfer emerged. After the initial collapse, large-scale loose monetary policy strongly supported asset markets. In the following decade, stock and real estate prices rose faster than labor incomes, widening the wealth gap. The common thread in these examples lies not in political or geographical context. It lies in the structure of money and debt. When the system has to expand the money supply or credit to deal with the debt burden, scarce or price-adjustable assets are often revalued first. A recurring signature can be identified. First, debt accumulates to high levels during the preceding growth phase. Second, a shock financial, political, or economic forces a sharp easing of policy. Third, the currency loses purchasing power faster than the rate of income adjustment. Fourth, tangible and scarce assets experience sharp nominal price increases. Fifth, the asset gap widens. Not every cycle ends in hyperinflation. But most long monetary cycles end in some form of revaluation either of the currency or of assets. This doesn't mean history will repeat itself in the same scenario. The technology is different. The financial structure is more complex. Capital markets are more globalized. But the underlying dynamics, high debt, policy pressures, asset revaluation still appear to follow familiar patterns. And when historical patterns are juxtaposed with modern data, the sense of a long cycle approaching a more sensitive phase becomes hard to ignore. The ultimate question isn't which assets will rise by how much percentage. The deeper question lies in the nature of currency and ownership. Currency, at its deepest level, is not merely a medium of exchange. It is a social agreement of value and trust. When that trust is stable, cash is sufficient. When trust begins to waver, people seek things that cannot be diluted too easily. Land cannot be printed. Gold cannot be produced at will. Businesses owning physical assets can adjust prices according to costs. Even digital assets with a fixed supply are born from anxieties about monetary expansion. Every long monetary cycle raises the same question: where does real value lie? In banknotes, or in what banknotes can buy? When the money supply grows faster than real output, the imbalance cannot persist indefinitely without correction. Sometimes correction occurs through sustained inflation. Sometimes through banking crises. Sometimes through monetary reforms. But in most cases, assets are revalued before the currency is officially restructured. The list of 8 asset classes that appreciate when the currency weakens is not a portfolio. It is a sign of the power structure. It shows where money flows when confidence in the measure of value begins to crumble. The question is not whether a particular asset class rises sharply in a few years. The question is whether the system depends on the continuous appreciation of assets to maintain stability. When asset prices become the pillar of growth, of budgets, of consumer confidence, a reversal becomes far more dangerous. Therefore, in each monetary cycle, the appreciation of certain assets is not simply an opportunity. It is a signal. A signal that the currency is being tested. A signal that the transfer of wealth is underway. A signal that the foundation of confidence is shifting. The system may adjust gradually, without a major shock. The revaluation process may take years, silently and gradually. But history rarely stands still when imbalances have accumulated for too long. Looking back at previous cycles, what remains is not just the inflation figures or the rise in gold prices. What remains is the question of true ownership within a fiat currency system: who retains purchasing power, who is eroded, and why. And in the current context, with global debt at unprecedented levels, with assets having undergone multiple rounds of revaluation, and with the younger generation facing asset costs far exceeding income, that question becomes more personal than ever. It's not about what to buy. It's about which stage of a long monetary cycle we are living in. That cycle may not be over yet. But the signs indicate it is entering a sensitive zone where confidence, assets, and currency are beginning to be tested simultaneously. And when currencies are challenged, history shows that assets don't react uniformly. Some are wiped out. Some are revalued. And it is this difference that rewrites the map of wealth in each era.